Welcome to Sustainability Bridges, a Eurosif podcast that aims to build bridges between policymakers, investors, academics and civil society around the theme of sustainable investment. Eurosif, the European Sustainable Investment Forum, is the leading pan-European association promoting sustainable finance and investment at the European level. In these podcasts, Eurosif's Executive Director invites distinguished guests for a 30-minute conversation on current events shaping the sustainable investment community.
Hello, my name is Nathalie Dogniez and I'm the chair of Eurosif. For this episode of Sustainability Bridge, I'm happy to be joined by Bussières, head of DG FISMA Asset Management Unit at the European Commission. As our listener might already know, the European Commission published its long-awaited review of the Sustainable Finance Disclosure Regulation, or SFDR, last month, proposing significant changes to the current framework. This is a key file for many stakeholders working on sustainable finance, and we would like to take this opportunity to better understand what the European Commission proposes for the review, what it means for investors, and what will happen next. Hélène, many thanks for joining us today.
Thank you, Nathalie. It's a pleasure to be here.
So, should we start with the first question? I believe that many of our listeners will be familiar with the SFDR, but for those who are not, could you give us a brief introduction to this regulation and its objectives?
So the SFDR was first introduced in 2021. That's when it started to apply. And it's considered a major piece of work and major piece of legislation. And it's part of the many initiatives to deliver on the objective of the Green Deal. I think what is important to note is that when the SFDR was negotiated and discussed between the co-legislators, it was one of the first piece of regulations requiring and organizing how financial disclosures relating to ESG matters would be organized, structured, and communicated to investors. It was the first time in the world that a jurisdiction, the EU, would organize such disclosures. So it was, in that sense, a very, very important piece, and it had huge effects on market practices and on ESG data made available to investors. It's been in application for 4 years, a bit more than 4 years now, and the Commission has assessed how it's been functioning as part of the review we launched a few years ago.
Many thanks, Hélène. On a personal note, I would say that, I have been saying for the last 4 years that I love SFDR, and this is the only piece of regulation when I issued that statement. But the European Commission published proposal to review the SFDR on 20 November. This review follows a comprehensive assessment and aims to address the different challenges identified during the first year of implementation of SFDR. Could you give us a quick overview of the main changes the European Commission is proposing and what these amendments are aiming to achieve?
So the SFDR, as I was just referring to, has had huge effects on how financial market participants, so the industry, all financial intermediaries, had to organize their ESG disclosures. At the time, it was conceived purely as a disclosure regime, meaning structuring the type of ESG information that financial market participants have to consolidate, collect from underlying assets, underlying companies. And so one of the first feedback we received from the market on the SFDR is that it was relatively complex to operate. What I mean by that is that, the level of granularity of information, having access to information, communicating that information to end investors, it was identified by many users of the SFDR as complex. Another important shortcoming of the current SFDR is the fact that despite being conceived as a disclosure framework, it was used as a labeling framework. So you must be familiar with the concept of Article 8 and Article 9, being the sort of article structuring disclosures. But in practice, what we've seen in the market is that financial market participants were marketing their financial products as either Article 8 or Article 9 without the necessary conditions and requirements in the framework supporting this type of claims. Because being purely a disclosure framework, it didn't contain minimum conditions, minimum criteria, ensuring that those so-called Article 8 or Article 9 products would comply with minimum requirements. And this, the fact that the industry has been making certain ESG claims on the basis of the SFDR was identified as a source of greenwashing risks by many investors and many actors from the industry, who've reported, and I think that's one of the main complaints we've heard throughout this almost 2 years of assessment, is the fact that the SFDR, despite its good intention, was creating a real risk of greenwashing and misleading claims for end investors. Final important aspect in the list of weaknesses that we've identified is the fact that the type of disclosures that were done under SFDR were either too complex for retail investors or not sufficiently elaborated for professional investors who have very specific needs. So in a sense, you have this problem of misalignment between the needs of end investors, either retail investors who need relatively high level and simple communication material. So for those retail investors, SFDR is in a sense too complex. And for professional investors, the type of information they would get is not entirely fit for their specific needs. So we had this issue of misalignment between what SFDR is doing and the type of information that investors need to receive. So that's a very brief outlook of the problems. And that's why the objective of the review is along 3 lines. So the first objective is to increase the robustness of the SFDR. Robustness meaning that we need to insert in SFDR the minimum conditions that will allow financial market participants to make certain ESG claims and to market financial products with minimum conditions allowing for the credibility and the robustness of those claims. So robustness is one. Second of all, we would like to make the SFDR more user appropriate, so fit for investors' needs. As I said, we need to, on the one hand, simplify the type of disclosures and the way information is communicated to retail investors. And on the other, we need to accept that for professional investors, they must have more flexibility to sort of establish their specific ESG needs bilaterally with financial market participants. And that's where the idea of product categories is so important, because it will facilitate, in particular, the communication and the interactions with retail investors. And final objective of the SFDR review, it's simplicity, meaning relying on concepts that can be understood and used by both the financial industry and then investors. And this idea of more simplicity, more alignment between the SFDR and other frameworks of the sustainable finance universe was particularly important. So a number of aspects of the review aim in particular to better align the SFDR with the taxonomy regulation, for instance, with the climate benchmarks that we have developed in the EU to ensure also better consistency with the CSRD, which has been recently agreed and revised by the co-legislators. So this idea of simplicity and alignment is the third important objective of this SFDR review. So with those objectives, what we're doing, and I'm sure we're going to discuss that in more details in a minute, is that on the one hand, we will simplify and streamline disclosures. And on the other, we suggest to create robust ESG categories that will facilitate information sharing with investors.
Yeah, it is a paradox, isn't it, that SFDR was loved so much by the industry that it was used beyond its initial intention. So the way to address it now is one of the main change proposed is introduction of categories of sustainability-related product with minimum criteria, and fulfilling the criteria will allow product to be named and marketed as sustainable, transition, etc. Can you explain the rationale between these 3 categories and some of the minimum criteria? And also let the auditor know how these were built upon or deviate from the recent ESMA guidelines on funds using ESG or sustainability-related terms.
So a lot of work went into the creation and the calibration of these three categories, indeed. So first, I would like to recall that the proposal and the way the proposal is structured is the result of a lot of consultations, a lot of engagement with stakeholders, with industry participants, with national competent authorities, representatives of the industry. We've tested different models. We've tested the model of like 2 categories, the model of 3 categories, different type of criteria underpinning those categories. So that's how we came to the result that now features in the proposal with 3 categories. One category, which is the sustainable category, which acknowledges the fact that some products will be invested in assets or projects that are already sustainable, so already compliant with the highest standards of sustainability ambition. The second category is the transition category. Here, the objective is to incentivize investment into assets and projects that support the transition in particular, the transition of the EU economy towards climate change. And finally, we recommend the creation of an ESG basic category that will be fit for products that do make efforts, that do implement some ESG investment approaches, but with a lower ambition compared to the sustainable and transition category. Those categories are built around essentially 2 pillars, and there are differences and similarities in the way those pillars are constructed. So all 3 categories contain a positive element, so a positive pillar, which is a contribution to an investment objective. Environmental objective or social objective, in particular for the sustainable category, a transition objective for the transition category, and a more general objective for the third category. Financial market participants will have to demonstrate that at least 70% of their portfolio aligned with that investment objective, the claim that are made by the financial products. So that's the positive elements. And of course, we do define in the proposal a list of investment approaches that are considered eligible to meet or to demonstrate the compatibility with the objective. The second pillar of the categories is the exclusions. So the fact that to comply or to be eligible for the category, financial market participants must demonstrate that they do not invest in certain type of assets or activities that are not considered compatible with the proclaimed investment objectives. So those are really the 2 driving elements for the categories. And we have established, so when it comes to the positive element of the categories, we have a list of investment approaches. Like if I take the sustainable category, for instance, we consider that financial products that qualify as sustainable could invest in EU green bond assets, for instance, or they could invest in taxonomy-aligned assets. They could invest in assets that demonstrate a real and credible sustainability objective. On the other hand, again, if I look at the sustainable category, we have a list of exclusions. And we've tried, again, with this objective of ensuring a maximum alignment with other pieces of the Sustainable Finance Framework, we are building on what already exists, and in particular, for the sustainable category, exclusions that are already in application under the Paris aligned benchmark. For the Paris aligned benchmarks, those exclusions have been available for many years already, and they are proving quite efficient. It seems, at least that's the feedback we have received. And therefore, we build exclusions for the sustainability category on those PAB exclusions. That brings me to another aspect of your question, which is the alignment with the ESMA guidelines on funds names. It's absolutely true to say that those guidelines that ESMA adopted last year have had huge impacts on market practices and on how financial market participants are making ESG claims. And so we've decided, when looking at how to structure the future framework, we've decided to largely build on those ESMA guidelines. But we also consider that certain aspects of the guidelines had to be strengthened to make the framework even more robust than it is today. And that's why we've deviated on certain aspects of the guidelines. And I think one particularly important aspect that I would like to highlight today is the fact that we've added for the sustainable and transition categories, we've decided to add an additional exclusion in the form of not allowing investment in assets or projects that would support the expansion of fossil fuel activities. This is not currently an exclusion of the Paris line benchmarks, so this is an additional exclusion, but this was considered necessary to make sure that the two categories, the two more ambitious categories, sustainability and transition, would be sufficiently robust. So as a short answer to your question, we've, to the extent possible, tried to build those categories on existing market practices, and in particular those that the ESMA guidelines have generated. But to the extent necessary, we've made some adjustments to make sure the framework would be sufficiently solid and would also ensure that retail investors are not confused by the type of assets in which they invest when having a conversation with their financial advisors on the features of sustainable products.
According to some of the preliminary feedback we received, some investors regret the deletion of the definition of sustainable investment. Despite some of claiming its lack of clarity, it created an incentive for asset managers to develop their own stringent methodologies to identify positive sustainable objectives and to ensure their investments are avoiding environmental or social harm while supporting companies with good governance. Would you say the criteria behind the sustainable category leave room for such approaches and create the same level of incentives?
This has been our objective all along, in fact. As you may be aware, a number of stakeholders considered that the definition of a sustainable investment as a concept was a good one, but the way it is implemented in the current SFDR makes it difficult to operate in practice. And that's why our recommendation for the future SFDR is to say that we would not keep the concept of a sustainable investment as it is today under Article 217, but we would maintain the building block that supports the definition of a sustainable investment and apply it to the different categories. So again, if you look at the definition of sustainable investment today, you have a positive element, a contribution to an objective, and sort of a negative leg with the do not significant harm. And that's why we've decided to convert this concept of sustainable investments with this positive leg of a contribution and negative leg of exclusions. So we keep the spirit, if you want, of the sustainable investments, but we make it more suited to a product categorization system. So I think it's not correct to say that we are lowering the ambition by removing the concept itself. It's quite the opposite. We are strengthening the ambition by making the individual component of the definition more operational under the three categories.
As you know, sustainable investment fora are often involved in national labeling scheme. How is the SFDR review categorization system intended to interact with national labels?
There will be interactions. We've tested with some member states on a bilateral basis the features of their, in particular, national regimes. But at this stage, the position of the Commission is that we are not regulating or we are not forcing anyone to adjust their national labels or the criteria of any ad hoc ESG label. What we expect is that over time, there will most likely be a form of convergence in the sense that national labels would either align very clearly with one of the category, in which case financial market participants could fit in one of the SFDR category and at the same time claim the benefit of a local or national label, or when there are discrepancies, it would be for the financial market participants to decide whether, they want to meet the conditions of the label and whether they are in the capacity of using one of the SFDR category. I think the criteria of the SFDR categories will be sufficiently clear to allow financial market participants to establish whether they meet those conditions or not. So probably over time a form of convergence, but it's going to be for member states to decide how they want to implement this convergence in practice. One thing that probably I would want to highlight here, because we haven't had the time yet to discuss this aspect, is the fact that we are making a very clear link in the proposal between the categories and the naming and marketing rules. So we are establishing the fact that it's not possible for non-categorized products to market themselves as under one of the category if they don't meet the conditions. I think it's a very important step compared to the current SFDR, of course, provided that the co-legislators agree and endorse this approach. But it's a very important step because it means that it's not going to be possible for non-categorized products to make and to market openly their products as ESG, which is clearly one of the main weakness of the current SFDR. And so we want to establish that marketing claims have to be backed and supported by real evidence, real justifications.
The review overall proposed significant changes in SFDR disclosure, both at the level of financial institution and at the level of financial product. For instance, principal adverse impact indicators have become a central element for investor decision-making, as many investors use them as a basis for investment and to conduct their engagement activities. The SFDR review deletes the current list of mandatory PAIs. Are some disclosure on adverse impact maintained? And if so, for which products?
I would first start by saying that evidence we've collected over the years of assessment of SFDR tend to show that entity-level principal adverse indicators were actually not used, or at least not to a very large extent, by investors. That's probably one of the main findings of our analysis, is that with the exception of a few principal adverse indicators, the rest of those indicators were considered either not sufficiently robust in terms of underlying data or not sufficiently capable of measuring a real impact. So what I want to say here is that if you take the list of the 14 mandatory indicators under the current SFDR, we came to the conclusion that only 4 or 5 of those principal adverse indicators, impact indicators, were really used to support investment decisions. Other indicators were used, but to a much lower extent. And most stakeholders tend to believe that making those indicators voluntary instead of mandatory would be a much better outcome for investors, because those financial market participants who have the capacity to collect the data, to consolidate the data, analyze the data, will continue to make use of those principal adverse impact indicators for the benefit of end investors. But for those PAIs that are not sufficiently robust and supported by concrete and relevant data, it's not justified to make them mandatory for all entities and all products. That's why, in fact, in the proposal, we are proposing to remove entity-level disclosures entirely from the SFDR. So we established that the SFDR is essentially a product-level regime. However, we keep the possibility for financial market participants to use principal adverse impact indicators for the sustainable and transition category. What I mean by that is the fact that for products that claim to have a sustainable or transition ambition, they will have to identify and disclose the principal adverse impact of their investment strategies, and they will have to choose which PIAs are most appropriate to precisely demonstrate their compliance with their objectives. So in a sense, we keep the concept and we keep the notion of principal adverse impact indicators, but we make them voluntary. And that's also part of the objective to simplify the framework and to make it more sort of proportionate in terms of burden created for FMPs versus benefit for investors.
Similarly, are taxonomy alignment disclosure still required for some product?
So by default, no. So for none of the categories, it's going to be mandatory to disclose the degree of taxonomy alignment. However, for products that claim to have an environmental objective, they should say whether the taxonomy is the reference framework for measuring their alignment with the environmental objective. So we expect, based on our consultation, that the taxonomy regulation will continue to be used as a reference point for measuring environmental objectives and especially for those products that claim to have climate transition as one of their main objectives.
The SFDR review does not include any dedicated disclosure for non-categorized products, apart from how they consider sustainability risk. Was such an option discussed during the preparation process to have all products to make some disclosure? And why is it not included in the final proposals?
That's in fact a dimension of the proposal that has been extensively discussed with many stakeholders, whether we should keep a minimum set of disclosures for all products, both categorized and non-categorized. But the essential feedback we got from many stakeholders is the fact that it would be confusing for products that are not categorized to be able to make some active ESG disclosures towards end investors. And that's why we've decided that for non-categorized products, of course, they remain subject to the obligation to make disclosures on sustainability risks under Article 6. It's also possible for them to make certain ESG disclosures in their contractual documents, but it's not possible to make ESG disclosures in a proactive manner or in a way that could send misleading messages to end investors and in particular retail investors. So we establish a very clear distinction between those products that make ESG claims, that can back those ESG claims, and therefore belong to one of the three categories, and those products can market towards end investors, and non-categorized products for which we've decided to really limit the ability of making outward claims. So for those non-categorized products, disclosures are still possible in contractual documents, but they shouldn't be marketed to any investors.
Entity-level disclosure are a controversial topic. However, many investors were still keen to maintain such disclosure, as it allowed them to clearly flag their action to address the adverse impacts of their investment, especially since the Omnibus initiative removed the European Commission mandate to adopt sector-specific standards for financial institutions. Additionally, European authorities regularly highlighted the usefulness of this disclosure for supervisory purposes. So, what was the rationale behind their deletion?
It's true to say that entity-level disclosures were one of the core components of the initial SFDR, as it is currently in application. However, the feedback received during the assessment, again, so during the consultations, the various workshops that we organized with industry participants, show that those were not used significantly by investors, and they were not either used significantly for supervisory purposes. That's why we've decided to ensure some consistency, in particular with the scope of the CSRD, now revised CSRD, as per the agreement recently reached by the co-legislators, and to clearly indicate that the SFDR would contain product-level disclosures and that all entity-level disclosures would now belong to the scope of the CSRD, therefore establishing this very clear distinction between the purpose of the two frameworks. I think there are several justifications to that. Well, first of all, there's a question of costs, because of course it's costly to establish certain type of entity-level disclosures, to produce those disclosures, to collect the data, etc. But it's also a question of duplication, because to the extent that such disclosures are made under the CSRD, the question is legitimate to then ask whether it's justified to require those disclosures to also be done in another legal framework under another regime, even if to a very large extent we've tried to align the CSRD disclosures and the SFDR disclosures as they are done today. So that was mostly the reason for deciding to scope out of the SFDR entity-level disclosures.
I would like now to focus on the scope for a moment, so to whom this regulation applies. In the proposal, the scope of SFDR is revised so that financial advisors and portfolio management services would no longer be covered. What was the reason for this change?
In the same vein, I think we now establish SFDR as a product level regime. We create very clear disclosures for products that are categorized under the various categories, and therefore we do not consider that it's appropriate in that context to require specific disclosures for asset financial advisors and portfolio managers. However, those will still be captured by the framework, but not under SFDR, or at least not entirely under SFDR. And here I need to explain. Financial advisors, who are those who interact with clients, will still be captured by the MiFID and IDD level 2 rules. As you know, there are certain obligations for financial advisors when recommending products to retail clients in particular. Those rules are established in the MiFID and IDD delegated acts. Those rules will remain in place, but they will evolve. In the future, we will revise those MiFID and IDD rules to align with whatever is the outcome of the SFDR negotiations, meaning that financial advisors will have to adopt sort of new behaviors to be able to sell and to recommend to their clients financial products according to the SFDR categories. So they will still be captured in a certain way by the SFDR rules, but they are no longer directly under the scope of the SFDR when it comes to making certain disclosures. As regards portfolio management, here again, the main reason for scoping out portfolio management is because portfolio management is a service, it's not a product. But we still foresee the possibility for clients to ask that when they are mandating financial intermediaries to manufacture certain products for them, they can ask that those services are provided following the SFDR categories, or the future SFDR categories, I should say. And so in that context, we make it clear in the proposal that portfolio managers should follow the preferences expressed by their clients.
SFDR links with many other EU rules, for example, the MiFID IDD rules on the assessment of clients' sustainability preferences. We understand the European Commission is also planning to make targeted changes to these rules to make sure they reflect the SFDR review. Can you elaborate on this?
Absolutely, that's correct. So as I said, there is a very clear and direct link between SFDR and the MiFID and IDD delegated acts. In the sense that, so as I explained before, financial advisors are subject to certain obligations when it comes to recommending certain products to their clients. And in particular, they have to assess the sustainability preferences of their clients. Under the current system, they are supposed to follow like a 3-step analysis, and they are supposed to ask their clients whether they want to invest according to the taxonomy or in line with the SFDR disclosures, or to take into consideration certain elements of the principal adverse impact indicators. It seems that this process is too complex and not particularly suited for retail investors who do not necessarily understand the specificities of the 3 grids, let's say. It would be much more efficient, from what we've heard from financial advisors in particular, to be able to follow a simple framework building on the future SFDR categories. So the 3 types of categories that we're proposing to establish once the revised framework is in place. And that's why if this new framework is approved by the co-legislators, we will, as part of the implementation work preparing for the application of the new rules, we will also revise and amend the MiFID and IDD delegated acts to align the analysis of the client's sustainability preferences with the existence of the new categories under SFDR.
The legislative proposal will now be discussed by the EU co-legislator, the European Parliament, and the Council of the EU. What are the next steps, and by when can investors expect to apply the new rules, especially with regards to the new delegated act replacing the current SFDR delegated regulation that will shape the detailed disclosure at product level? And can you provide more clarity as to the sequencing, the implementation timetable, in particular for existing products, but also for phasing out of current requirement under SFDR1 that will no longer apply?
Negotiations are a long process. It's extremely difficult to anticipate how much time it will take. So on this aspect, I really cannot predict, but we'll take the necessary time to ensure the best outcome for EU citizens. Usually it takes some months or maybe up to 2 years to negotiate a legislative framework. Maybe in that case could be a bit quicker. Let's see. But in any event, once the the parameters of the new SFDR are agreed, there will be an implementation period of at least 18 months. At least in the proposal, we foresee 18 months. The co-legislators may wish to extend that implementation period, to be discussed. And during those 18 months, the Commission will work on the level 2. As I said, so the level 2 of SFDR, which will be a priority, of course, but also the level 2 of MiFID and IDD, to ensure a perfect alignment of all implementing rules, so that on the day of application of the new upgraded SFDR framework, everything is in place, everything is clear for financial market participants and investors, so that they know exactly what to produce or what to expect from the manufacturers. We will do all possible efforts to prepare the level 2 in a relatively short amount of time, so that there is enough time for the industry to be able to implement and prepare for the application of these new rules. But again, this is going to be discussed in the context of the negotiations, so it's a bit early to predict what the likely application date would be for the new SFDR. But taking into account the various steps, I would expect probably in something like 3 years from now, more or less, maybe 4 years, depending on the transition phase that is agreed by the co-legislators.
Thank you, Hélène, for joining us today and for this insightful conversation. Many thanks.
Thank you, Nathalie. It was a pleasure.